that if you're looking at funding a 30-year project, you shouldn't fund it with 1-year money. So you have a lot of 1-year money available. So that's a very important aspect. That's why the domestic bond markets today are not really meeting. I mean, in addition to all the other points mentioned, one of the key things that's required is whatever is the type of project, you have to fund it with that type of capital, right? You cannot fund infra project with a manufacturing kind of capital, a manufacturing project in the infra kind of capital, right? So to that extent, I think diversification of sources of finance is paramount, very important. And as an organization, we have we've gone on that path about 5 to 6 years back, and today where we are is we've been able to get one third between domestic banks, international banks, and the capital markets, primarily international capital markets. It's on the availability of onshore capital, I'll just say that one of the things that India can learn from China is from an availability of onshore capital, both bank capital and bonds. There's a lot of capital available in onshore markets as well, right? So therefore, when they look at international funding, they look at it either because of specialized needs or when there is a cost of capital arbitrage, that the onshore markets, for whatever reasons, are more expensive as compared to international markets. Issuers can tap both. I think if you can take the example of a very small market like Taiwan, today Taiwan is a market which is a capital exporter. It is actually because of the dollar exports that they do of the semiconductor, they receive so much dollars that they are actually investing into a big player in the Indian infrastructure sector because they are funding a lot of these projects. So capital is available, yes. Whether onshore capital availability, and this is more I'm talking on the debt side, is meeting the requirements of the projects, and cost of capital is secondary. I think cost of capital moves through cycles. If you have interest rate cycles like you have in the dollar markets today, they'll move through cycles. So that is secondary. That is the availability of capital, and availability of right capital is more important.